So lesson 2 I call the accounting equation. And what I love about this beautifully simplistic equation is it reminds me of Einstein's theory of relativity, which is E equals mc squared. It's so simple, but it's the universal basis for communicating an entity's net worth, and it sort of describes the heart of a company. So here's the equation, which I will dissect, but also move around a bit to make it more palatable. Assets equal liabilities plus owner's equity. Okay, so first off, let's define each element of the equation. Most people intuitively know what assets and liabilities are, but there are some subtleties worth describing if you want to start seeing things from an accountant's perspective. So first off, assets. Anything that holds future value is an asset. Cash has future value. It can be used to purchase goods, services, or employee resources in the future. Monies owing from customers or receivables have future value. Expenses that I've paid up front for that have future usefulness, for example, annual insurance, has future value, and this is called a prepaid expense. Equipment has future value. Vehicles have future value. Goodwill has future value. Inventory has future value. The question you ask yourself every time you spend money for something is this: is there future value for this expenditure? Like, will this somehow help either directly or indirectly generate future profits that'll eventually result in cash? Or is this just an expense? In other words, the money's out the door and gone like a fart in the wind. Liabilities are obligations to deliver assets to third parties or related parties in the future. It's like the opposite or reverse of an asset. So monies I owe my suppliers for goods or services they've delivered to me that I have not yet paid for, but I promise to pay for sometime later in the future. I will deliver cash, an asset, to settle my obligation. And these are accounts payable. When someone loans me money, they've given me cash to purchase something now that I don't want to use my own money for now, for whatever reason, mainly because I don't have any. And I promise to pay back or send cash, which is an asset, over time, usually with interest to fulfill my obligations. And of course, this is a loan payable. A liability is also created when someone pays you money for a good or service that you've not yet delivered to that person or customer. Sometime at an agreed upon future date, you will deliver that good or service, but in the meantime, you owe an obligation to that party, and these are deferred revenues. Owner's equity is made up of a couple of things, including a record of the monies owners put into the business to get it started, plus the sum of the total earnings since inception, less the total distributions, or better known as dividends. But look, I'm going to park this section for another lesson because there's actually more moving parts to this one, and I don't want to overwhelm you today. But for now, I'd like you to simply think about owner's equity as the difference between the assets we own and the liabilities we owe, which just makes sense. If someone asked you what your net worth is as a person, you would tally up the stuff you own, like a house or a car, some cash savings or RRSPs, and then you tally up all your credit card balances and maybe a mortgage, and you would take the difference and all this to determine your net worth. Although, I think even without all that stuff, your net worth is priceless. Okay, so back to the accounting equation. Assets equal liabilities plus owner's equity. Now, here's a quick refresher in algebra. I can move variables in an equation to the other side of the equal sign as long as I change its sign. So if I move liabilities to the right of the equal sign and put a negative in front of it, I now have assets minus liabilities equals owner's equity. And they're the same equation, just expressed differently. This equation makes a little more intuitive sense to me because I totally get the notion of I'm worth the difference between what I own and what I owe. Assets, liabilities, and owner's equity are nicknamed balance sheet accounts. And they got that nickname because if you look at a balance sheet of a company, it has assets listed and added all up on the top half of the page. And on the bottom half of the page, it has all the liabilities added up and the owner's equity all added up. And guess what? The top half of the page total equals the total on the bottom half of the page. It balances. It's magic. It's actually not magic. It's a function of the double entry accounting system, which we talked about in lesson 1, but it has to balance. If it doesn't, you've messed something up. There is no such thing as a balance sheet that doesn't balance. And frankly, I don't want to live in a universe where balance sheets that don't balance can exist. It would be complete and utter chaos. Okay, so to recap, today we learned the basic accounting equation. Assets equal liabilities plus owner's equity. We've unpacked what assets and liabilities are, and we skimmed over owner's equity a bit. And we learned that these are called balance sheet accounts. Now, for homework, I want you to think about the things that you see around your business or your home or whatever, and think about whether they are assets or liabilities, and think about why. This has been a lot for today, so I'm going to bid you adieu for today, but we will take a closer look at balance sheets in our next lesson, okay? Does that sound like a plan? Now remember, in addition to doing this channel, We Love Small Business, I'm also the president of Swain CPA. We are accepting clients. I'd love to have a chat with you. See you next time.